So let's learn the basics. So the first thing you gotta understand is that when you look at the stock market or whatever it is you're trading, it goes through cycles. Okay, nothing goes up forever, nothing goes down forever. And the stock market cycle goes this way. There are times when the market is on what we call an uptrend, where prices make higher highs and higher lows. And this is when the economy is doing well, when there's optimism and prices keep going higher and higher and higher. But eventually prices will go into what we call a consolidation. That means from going higher and higher, it will start to go sideways in what we call a consolidation pattern. Price makes same highs and very often same lows. And then whenever there's uncertainty, there's a recession, there's bad news, that's right. Stock prices can collapse. They can go on a downtrend that could last for 1 to 2 years. And this is where most people who invest in conventional products will start to lose money and see their savings dwindle down. But I'm going to teach you that in professional online trading, whether it's on an uptrend, in a consolidation, or on a downtrend, we're going to be making profits, passive income consistently. All right, so the cycle, as you can see, continues. So how do we profit from this cycle in any circumstance? First, let's take a look. So whenever the market is on an uptrend, and I'm going to teach you in the course how to identify clear uptrends, when the price is making higher highs and higher lows. So when the stock is on an uptrend, it is statistically proven that prices will move higher in the short term. So what we're going to do on an uptrend is we want to buy the stock at a certain price and sell it at a higher price to make a profit. I mean, that sounds like a lot of common sense, right? But again, now let me teach you something that will go against what you know about stocks. Most people think that, okay, if you want to buy a stock, I'm just going to hold it as long as I can and make as much as I can. Well, that's why most people lose money, because that's not how stocks work. If you want to make a monthly income or an annual income, you must know when to enter and exit quickly and effectively. So here's a very important lesson. Whenever you buy a stock as a professional online trader, you need to have 3 prices or 3 points in each trade. First is the entry price. So for example, if I'm going to buy somewhere around here, and in the program, I'm going to teach you exactly when to buy. Exactly when to buy before the price starts going up. So if you buy over here, for example, and this is $50, okay? Now, as professional traders, we have to understand that prices don't always go the way we want. Sometimes they can go down instead of going up. So when it goes down, we will lose money. Okay? Now, when you lose money, you have to sell to cut your loss quickly. And we do that by placing an automated stop loss order where the computer will sell for us automatically, even if we are not there, we are sleeping in our beds. So if you buy at $50 and you place a stop loss at $48, you are risking $2 for every share that you buy. I'm going to teach you how to calculate the number of shares to buy. We call this position sizing, in such a way that if it hits your stop loss, you will only risk 2% of your capital, of your retirement savings. Now, if it goes the way we expect, which will be most of the time, we must also exit the trade with a profit. We have to take profit at double the risk we are taking. So if we are risking $2, the moment the price rises by $4, which is double the risk, we will exit automatically. Again, the computer will sell it for you automatically. I'm going to teach you how to do that so that you exit with a profit of double the risk. So when we're risking 2% on our capital, when it goes our way, we get a 4% return on our capital. Does it make sense? And it's all automated. It all happens when you sleep. You just have to program everything in the computer system. I'm going to teach you how to do that. So there are 3 points in every trade. Again, the entry price. You have got the stop loss price, which is the price where the trade exits with a loss. And when that happens, you risk 2%. and the take profit price, which is the price you exit with a profit. And that will represent 4% of your capital. So this is what you do when the price is on an uptrend. Now, what happens when the price is on a downtrend? When price is on a downtrend, it is statistically proven that prices tend to move lower in the short term. So what we're going to do is we're going to do what we call a sell, a short sell. Short selling means we sell at a high price and we buy back at a lower price, hence making a profit. And you're going to learn exactly how to do that in the training program. Okay? So for example, we're going to sell somewhere over here, for example. And that's our entry price, where we're selling at $50. So when it goes down, we are making money. If it goes up instead of going down, we are losing money. We must always be realistic to understand we can't always be right. So if it goes up and we are losing money, we will program to the computer to cut our loss and to buy back the shares so that we only risk $2 a share in this case. Again, you learn how to calculate the number of shares to buy so that that represents only a 2% risk on your capital. If the price goes down as we anticipated, we have to also program the computer to sell and take profit at double the risk, which is in this case $4 lower than $50, which is $46. So that will give us a profit gain of 4% on our capital. So once again, whenever you enter a trade, you need to have 3 orders simultaneously: the entry price, the stop loss price, and the take profit price. So in the training, I'm going to show you specific strategies on exactly when to buy and when to sell. And here's a preview. One of the strategies you're going to learn is called the bounce strategy. If you observe stocks on an uptrend, you realize that they tend to bounce off a moving average, which is a mathematical average of past prices. So in this case, you can see the price, when it goes up, it goes like a wave, up, down, up, down, up, down. That's how stocks behave. And when they go down, they tend to hit a moving average. In this case, it's the blue line over here called the 50 moving average. You can see the price going up, hitting the moving average and continuing the trend. So this is an ideal time to buy on the uptrend. So in this case, we're going to buy at $89, anticipating it's going to go up, we're going to make money, but we're going to place a stop loss at $84.50. Why? Because in case it goes down, we have to exit and take a small little loss. So what's our risk in this case? Our risk is $4.50 per share. 89 minus 84.50, right? So that's our risk. So if that's our risk, we have to also exit at double our risk, which means the moment the price reaches $9, which is double $4.50, we sell at $98. Once again, if it hits our stop loss, we are going to risk 2% of our capital by buying the appropriate number of shares. When it hits our profit target, we're going to gain 4% on our capital. It will always be this way. All right? And you're going to learn specific indicators and price action patterns to ensure that when you buy, all the stars are aligned in your favor. So there's a very high probability the prices will go in your direction. Here's an opposite example, where this time it's on a downtrend and we are going to short sell. And once again, on a downtrend, notice that prices go down, retrace, continue, retrace, and go down, like a wave pattern. And very often when stocks move in this wave pattern, every time it goes up temporarily, it hits a moving average. So in this case, as you can see, the price is in this wave pattern, like that. And it hits the 50 moving average, which is a precisely good time to sell and make money as the price continues going down. So we'll sell at $34.50, place a stop loss at $35.50, so we are risking again 2%. It's always 2%. And that represents a $1 risk per share. So similarly, we take profit when we get double the risk. So once it drops by $2 to $32.50, we exit and get a 4% gain on our capital. Simple enough? Great. That's exactly what you're going to learn in the program. Here's one more last example. When a price is in a consolidation, remember, price can go on an uptrend, and after an uptrend, it starts to consolidate, moving sideways. When it moves sideways, you have to wait for it to break out of the consolidation, and that's the precise time you buy again at $16.50. You place a stop loss, you're risking $1 over there, and the moment it goes up, you take profit at $2. So you're always risking 1 to make 2. Again, this represents a 2% risk on our capital and a 4% gain on our capital. So once you learn all these strategies, you're going to learn exactly when to buy before the price goes up and when to short sell before the price goes down. Now, once you learn all these techniques that I'm going to teach you as a professional trader, will you be right all the time? The answer is no, you can't be right all the time because the market is uncertain. All right, it can go up, it can go down, it can go sideways, and you can't always be right all the time. But do you need to be right all the time? The answer is no. You don't have to be right all the time to achieve consistent returns on your capital in a very safe way. So, what is the secret to consistent profits in that case? The secret is understanding statistics and probability. And this is the exact same science that casinos use to always make money from the players. So here's a secret, is to have a profitable and powerful trading plan. Like I said, when you enter a stock and you are buying so that you want to make money as it goes up, you have a profit target and a stop loss price. When it hits your stop loss price, once again, you risk only 2% of your capital, and we achieve that by position sizing. In other words, there's a mathematical formula I'll teach you to calculate the number of shares to buy, such that when the price hits the stop loss, you always risk only 2% of your capital. And when the price hits the profit target, you will gain 4% on your capital. Now, what's the chance of this happening? Again, even if you follow the best strategies in the world, you can't be right all the time. You can't be right 100% of the time. But I can tell you confidently that you'll be right 60 to 70% of the time if you follow all the strategies I'm going to teach you. But there'll be a 30 to 40% of the time that you may still lose on the stop loss because the price goes down instead. So, with these odds, let's take a look at the outcomes. If you do 20 trades a month, for example, and on average, you're winning 60% of the time. Let's be conservative. Let's say you win 6 out of 10 trades, okay? That would be 8 losses and 12 wins. Now, bear in mind that whenever you make a loss, you are risking 2% of your capital. And for every win, you're gaining 4% of your capital. So the net result is 32% return a month. So here's the point. You don't have to be right all the time. Even if you're right 60% of the time, you're getting a 32% return on your capital every month. Now, I know I told you only 5%. Why? Because I'm really ultra conservative. I want to make sure that in the worst case scenario, even if you make a lot of mistakes, you are still making money because we want to do it in a really safe way. Now, let's take a look. Now, what if you can only be right half the time because you make some mistakes, you're not too clear about the strategies, and it's like a coin flip, right? You're right half the time, you're wrong half the time. So with 20 trades a month, you are getting 10 wins and 10 losses on your professional trading capital. And again, each loss would be 2%, and each win would be 4%. That still gives you a 20% return a month. Okay? Now, what if you really suck? You're terrible at this, and you're worse than random luck. And you can only be right 40% of the time. In other words, you're wrong most of the time. Out of 10 trades you make, you're losing 6 and you're winning 4. And I can tell you that's terrible, that's horrible, right? Even in that case where you only win 8 and you lose 12, but because of my secret formula, where your profit target is double the risk, what's happening? That's right. When you lose 2%, you make 4%. Hey, you're still getting 8% return a month. Okay? So the 5% return a month, which I showed you earlier on, is really the most ultra conservative I can ever give you. That says, even if you're worse than 40%, you should be getting 5% return a month. And this is exactly what I do in my professional trading. So these are one of my accounts, as you can see. And with this account, I'm able to basically cover most of my household expenses, and the rest of my money I invest in many other things like real estate. I buy cars, I buy all kinds of things. And you can see that although I talk about an average of 5% a month, it's not always 5%, because the market is not a perfect science. On certain months you get more than 5% return, and certain months you get less than 5% return. So for example, these are the last couple of months of my trading capital. This is recently May of 2016. For the month of May, my capital returned 13.43%, which is about 32,000 US dollars in profits based on that capital. And in June, the return was 8.13%. Now, if you can remember, in June of 2016, what happened? It was Brexit, right? The UK voted to leave the European Union, and the stock market collapsed. And most people who bought conventional products like stocks for dividends and bonds, they lost money. But even then, I still got an 8% return on my capital. Why? Because whether the stock goes up or it goes down, I'm still making money. Because when it goes up, I buy low and I sell high. When it goes down, I sell high and I buy low, called short selling. I don't care where it goes. I make money regardless of the market. So it's really safe if you know what you're doing. All right? July was a 7.85% return on my capital. All right, so it's not always 5%. Sometimes it's more than 5%. Sometimes it's less than 5%. August was a 16% return, and the most recent month that just passed, September, was only 2.96%. So you can't win them all. And I'll tell you that there are months that I do get negative returns. I've got minus 1% return a month, and that was when it really sucked. It's terrible, right? But the next month, boom, I had a 20% return, right? So I'm saying 5% on average, right? So I always say that trading is the perfect business to be in. See, I've got so many businesses. I'm in education, I'm in all kinds of businesses. And to me, this little business of mine, which I call professional trading, is the best one. Why? Because I only spend less than 2 hours a day to find these trades and to enter the orders with my stockbroker. And all the buying and selling and the taking profit and stop loss are all automated. It all happens when I'm sleeping. It's purely passive. I can work from anywhere in the world. I travel with my family. I'm still making money. And no employees in this business, no rentals to talk about, no competitors, okay? Because we can all make money together, and it's recession proof. And you don't have to start with 100,000 obviously. You can start with $3,000, but it's all a matter of rate of return, right? So if you're starting with $3,000, you get 5% on 3,000, then it's about $150 a month in passive income, right? So you got to start small and you build your capital from there. And the best part about it is low risk. It is low risk. Why? Because like I said, if you put all your money in the stock market or the bond market in the conventional way, and we get a financial crisis, stock prices can drop by 20, 30, 40%. And that's risky to me. Excuse me. But if you become a professional trader and follow my rules of risking only 2% of your capital, right? Even if you're wrong 5 times in a row, that's a 10% risk. But again, usually after the 5 losses, you get 5 wins, right? And you end up the month, or at least the quarter, positive as well. So it was through trading that I made my first million by 26 years old, and that's how I got so-called famous in Singapore, and I was ranked among the top 25 richest Singaporeans under the age of 40 years old. Of course, I'm older now, I'm 42 years old, so I'm financially free, but I still spend my time teaching and sharing my ideas because, I believe that, if I teach you this stuff, you win, and I get to do something with my life that's beyond money. So why not teach it, all right? So if you want to learn more, I have developed a school called Wealth Academy. Been running it for the last 12 years. It's an award-winning program, an award-winning school. We have trained over 7,000 people in the last 12 years, of whom many of my students are today professional traders and fund managers. So if you want to find out more, you can go to my website, wealthacademyglobal.com, and start this journey of financial freedom. This is Adam Khoo, signing off. Take care and take action. And I'll see you soon in my program.